So I have, hi everyone, I'm live on Facebook and I am live on Instagram. And I have Alicia Stringer here. My name is May Dildal. We're going to talk about 3 ways to profit from high interest rates. A little bit about myself. I live in Waikiki with my son Jordan, who is 10. I was going to say he's 3. My God, he's 10. Okay. But when I started doing this, when I quit my job and became full-time mom and investor and started coaching clients on financial freedom, he was 3 years old. Okay, so I had a backflash, something going on there. But anyway, back in 2011, I had a lot of debt, credit card debts, all kinds of stuff. Never owned property, so it wasn't property debt. It was just credit cards, overspending. And I paid it all off by 2016, quit my job, started coaching clients, what I did, improved our net worth by $500,000. It was negative before then, back in 2011. And bought properties, bought 3, sold 1. So we own this 3-bedroom condo in Waikiki and another 1-bedroom down the road, which is an Airbnb business. So I have a blog called yesfinanciallyfree.com. Check it out. Click on the link in my profile on Instagram and underneath this post in Facebook and learn more about it. On the right side, there's actually a part where you can put in your first name, email address, and get a free ebook, Working Parents Guide to Financial Freedom, sent directly to your inbox. Okay, so Alicia, why don't you introduce yourself? Tell people who you are.
Yes, I am Alicia
Yes.
Houston, Texas, helping business owners win for their social media like me and teaching piano and voice. So living life with a fun young daughter as well and making things happen. Yeah, making a difference in the world, right? Helping people.
Good times. Yeah, Alicia, I met her at an internet marketing conference because I was trying to figure out how to make money blogging.
Yes.
And Alicia was sitting next to me and we got to know each other. And she wanted help getting enough. Well, she didn't have money to buy food. She got to the conference and didn't have money to buy food. So I was like, hey, I can help you with the money situation. So that's how we kind of got connected there. But anyway, so she's doing lots of big business now. She has a piano studio. She's figuring out logistics on moving that. She's got a lot of stuff that is really interesting that she didn't have to deal with before, or she wasn't at the level where she could have a business like that and do this kind of thing. So she's definitely changed a lot over the years. So excited to have you here. So interest rates right now, right? They are over 5%. Yeah. And Alicia, you're taking advantage of that, right? How are you taking advantage of high interest rates?
Savings account. Yeah. Put money in that savings and seeing more of that grow, that residual income grow. Putting that more into investments.
So how much is your savings paying you?
5%.
Yeah, over. So your actual high yield savings account is 5%.
Mm-hmm. Yep, we're pretty close to it. Maybe it's 5.9 or something. I have 2 of them. Yeah.
I think the one is actually over 5%, right? The one that you switched over to.
Yeah. So I have 2 of them that are pretty close to those high interest rates. Yeah.
Yeah. So, okay. So that's one of the methods. So this blog is about 3 methods to take advantage of high interest rates. Okay. And, oh, wow. There's interesting stuff here. Wow. Okay. Ray Dalio is going nuts. And I was going to share with you guys some stuff from Ray Dalio. So the 3 methods to get higher interest, take advantage of high interest rates. And Ray Dalio is kind of going to town right now and he's sending lots of emails. And he's the one who inspired me to do this blog. Okay. So Ray Dalio is a hedge fund manager and he created Bridgewater, which is a very successful hedge fund during the housing crisis. That's when he became especially famous because during the housing crisis, his hedge fund made tons of money. Okay. So basically he successfully predicted the housing crisis and profited from it. So after that, a lot of people, US governments, very large organizations started asking him for assistance. before that, he was also still helping, he like helped McDonald's create the chicken McNugget. So if you're wondering what that means, do you know about the chicken McNugget story, Alicia? Ray Dalio and chicken McNugget.
Yeah.
So what Ray Dalio does is he does commodities. He used to do commodity trading. And what that means is like if you wanted to buy chickens, coffee, cacao beans, oil, gas, commodities, things, right? He helped people create contracts where they can buy things at certain prices. Now, when McDonald's wanted to do chicken McNuggets, they didn't know if they could sell it at the price they wanted because the prices of chicken go up and down all the time. Yeah. So they needed to lock in the price of chicken in order to create the chicken nugget on their menu. So Ray Dalio helped them through options contracts lock in the price of chicken so that they can afford to make chicken nuggets at a certain price. So
Wow.
I bet you didn't know that about Ray Dalio. Yeah. So, you know, the fact that he profited during housing crisis, the fact that he's like the advisor to the US government on different kinds of treasury bills, he created the inflation adjusted tips treasury bill with them. But I think the chicken nugget story is the best story because it's like without Ray Dalio, we wouldn't have chicken nuggets. Yeah. So it's like, it's a funny story. I don't know if we wouldn't actually, maybe they would have hired some other commodities guy. I don't know, but Ray Dalio is pretty crafty. So I don't know. He was pretty smart.
Yeah.
So Ray Dalio put out an email and he just put out another one, which is why I was like, oh my gosh. But anyway, I'm going to share my screen and just kind of tell you what prompted this whole, what prompted me to do this is this email I got from Ray Dalio. The thinking behind why cash is now good and not trash. So in 2020, Ray Dalio said cash is trash, okay? And now Ray Dalio is saying that cash is good, all right? So people are like, why did you change your mind? Well, he created an article, and so I read it this morning before I wrote this blog. So basically what his reasoning is the same as what I've been saying the whole time, is that obviously interest rates are pretty high. Over 5% is almost what the stock market was making if you just had an index fund before. They said it was averaging like 6%. And you have a guarantee of your money. So in a stock market, your money goes up and down all the time, right? I mean, if you have your money in stock market now, you're probably so sad because the market was so down, you know, it was so down. Don't look at it. Stop looking at it. Okay? But if you have your money in treasury bills or high yield savings, you feel good because every time you look at it, it goes up because the interest keeps growing, right? So you don't have that, you know, sick feeling in your stomach like, oh my God, my money keeps going down in value. And if you have bonds and stocks, they're both going down. But if you have these treasury bills or cash, basically, then you're good to go. So let's talk about it. The thinking behind why cash is now good. So he talked about, he said his comments over the last couple of months is that cash is good, which was the opposite of his comments in early 2020 that cash is trash, okay? So a lot of people have been asking him questions, so he decided to write this article to explain what he's talking about. To be clear, what I tried to convey both times is how attractive cash is based on the interest rates offered at those times. So this is obvious, okay? I mean, the rates were trashy in 2020 because they were less than 1%. I think we can all understand that. And they're pretty good now because they're 5.5%. I mean, this is not rocket science, guys. I don't need to be Ray Dalio to know this. Alicia knows this, and she's not Ray Dalio. Okay, so it's like sometimes cash is good and sometimes cash is bad. I think we understand this, yeah. This is based on the number of measures I use and want to pass along so that I can help you fish rather than get you a fish, whatever. So he's basically going to share what he looks at to figure out whether cash is good or not. First of all, the level of the interest rate relative to the inflation rate, whether the Fed is likely to tighten or ease based on whether inflation and growth are higher or lower, the attractiveness of the expected cash return relative to the attractiveness of other investments based on their prospective returns, right? Number 4, supply and demand picture for cash and bonds. And those are the factors. And that's a little geeky for us, but let's just go through it real quick. A, interest rates are rising, which we already talked about, right? Many times. Interest rates have been going up, right? That's why stocks, the value of stocks have been going down. It's because interest rates have been going up. So interest rates are rising and the risk-free interest rate is more than 1% above the inflation rate. I didn't know this, but apparently this is true. Okay, so interest rates right now are 1% above the inflation rate. So that means it's better to put your money in cash now, right? B, when the real interest rate is at or above the economy's real growth rate, or said more simply, when the interest rate is above the economy's total growth rate, the more above the inflation and growth rate, the more I want to lend, and I want to borrow when the opposites are true. So basically, that means the interest rate is at or above the economy's current growth rate, right? Now, I don't know this either. I mean, if you were asking me, what's the economy's current growth rate? I'd be like, I don't know. Google it, right? I guess the economy's current growth rate is below 5.5%. That sounds right. I think the economy's growth rate was at 3 or something. I don't know. I'm just remembering vaguely. Do you know what we're talking about here? So Alicia is my gauge of the common people, and I want you to tell me if you're getting confused, okay?
All right. I'm
So
calm.
speak up.
I'm okay.
Okay.
I think the understanding is like there's a median to want to watch and stay in, on interest rates and when you want to buy or sell or whatever as well. And going the extreme, we're having to watch and we get really nervous. And I think a lot of people, don't know what to do in these extreme situations. So that's where I'm kind of learning what happens when, interest rates are way above they're supposed to be or whatever. And what are we supposed to be looking at?
Okay, cool, great. I'm always going to check in with Alicia because I don't want to lose you. And if I lose Alicia, I've lost you. So that's what's going on.
Check.
Do you know what inflation is, Alicia? Just want to make sure.
I probably can't explain it very well, but I kind of understand, how it's gone out of control.
So inflation is the price of stuff, right? So if you go to the grocery store and everything costs more, that's inflation. Does that make sense? All right. So if you go fill up your tank with gas and the gas prices are higher, that's inflation. So it's just prices going up. That's inflation. Yeah. So if the interest rate where you're earning money is 5.5%, but inflation's at 4.5%, which I guess is what he's saying. He's saying that it's 1% over inflation. So right now, inflation is at 4.5%, which means if you put your money in your bank, you're doing good because the cost of goods are growing at 4.5%, but your money's growing at 5.5%. So you're getting richer. Does that make sense?
Yeah.
Yeah? Okay. So for the longest time, interest rates used to be really bad. Remember, we started saving when it was below 1%, right? And inflation was at 2%. So if we saved, we were actually losing money because the cost of goods were going up higher than our savings were growing. Do you understand that now? That makes sense, yeah? That's what he's talking about. So if the interest rate is higher than the inflation rate, it's better to put your money in savings. So this is like a more technical way of saying what I've been saying. But basically, I've been saying, good morning. So let's move on. And then he also had, where did he have? He talks a lot about that one. Oh, I see. I must have missed his C. I don't know if his C is here. Okay. Then he talks about, to be clear, the numbers I used were for risk-free U.S. Treasuries. All right. That's what we're talking, me and Alicia talk about high yield savings accounts and U.S. Treasury bills. Okay. And he's talking about U.S. Treasury bills because high yield savings accounts, the reason they have high yields is because they're investing the money you put in the savings account into U.S. Treasuries. Okay. That's where the rate's coming from. All right. Just so you guys understand that. Of course, I want a higher interest rate for riskier debt. So he's saying that if he invested in anything that wasn't U.S. Treasuries, it would have to be at a higher interest rate than U.S. Treasuries, right? Does that make sense? Right? Right? If you can invest to the U.S. Treasuries and they give you 5.5%, are you going to lend to anyone else who gives you less than 5.5%? No way, right? You make them pay more interest. That's what he's saying, okay? Because they're more risky than the U.S. government. Okay, so on that basis, because I'm capturing a pretty good rate without a risk of losing principal, and if rates keep rising, I will get more and more because I didn't fix my rates. I don't want to own bonds which have maturities of over 10 years because the prices will fall during times when interest rates rise. That's why if you have a portfolio right now of stocks and long-term bonds, the whole thing's dropping. Okay, that's why it's dropping, because stocks will go down when interest rates go up. And long-term treasury bonds have interest rates that are lower than the current rates. Because long-term treasury bonds in 2020 were paying like 1%, which is really low, right? So why would anyone want bonds that are 1%, right? When you can have short-term treasury bills that are 5.5%. And you only have to have them for less than 2 years, 1 year, 4 weeks, 6 weeks, whatever. Why would it? So of course the price of bonds are going down for long bonds. So if you are sitting there wondering why are your stocks and bonds going down, and you have not, right now with the market, you've not made back your money yet. The high in 2021, it's gone down, it hasn't gone back up. It's not even close to being where it was yet. Now, if you take your money, like I took a huge chunk of money out and I put it in Treasury bills. Now that money, it's just going up in value, right? I've been doing it for a year now, right? And it just keeps going up and up and up, and Treasury rates keep going up and up. So I just keep doing short-term Treasury bills. It's really no brainer. But a lot of people don't do that because their money's with an investment advisor, or they just don't know how to do it. And they don't realize how easy it is. Yeah. I mean, look at Alicia. She's what I call the average person for money. Okay. All right. Okay. So she can open a high yield savings account, right? And she knows how to do Treasury bills now too. I taught her and she knows how. It's not too hard, right?
Right.
Right. So 3 ways. Get a high yield savings account. You can either, or you can buy treasuries at treasurydirect.gov, right? Or you can buy them through your brokerage account like Schwab or E-Trade or Morgan Stanley or Ameritrade or whatever brokerage account you have, you can buy US treasuries through there too. So those are 3 methods to get US treasury bills. All right. And if you want more information about it, click the link in my blog, but I have a post all about this. So yes, financiallyfree.com. If you go to my blog, you can find out all about this on my blog, because I have tons of information about how to buy US treasuries. I did whole blog posts on them. Treasury. Let's see if I can find it. Hopefully I can. Passive income with US Treasury bills. See, there you go. There's a blog post I did on August 11th. You could check it out. There you go. And it'll tell you exact. At the time, it was 5.25%. See, that was August 11th. Invest at Treasury Direct. You just click the treasurydirect.gov, right? You go there, you create an account, and you just start buying Treasury bills. That's what Alicia and I did. And you just go here and create an account. See? Open a new account. And it's that simple. So just go to my blog, yesfinanciallyfree.com. Yeah, today's blog post, or if you search Treasury, you'll find all the information you need. And on the right side right there, name, email, yes, get the free ebook, Working Parents Guide to Financial Freedom, sent directly to your inbox. Okay, all right, I'm done. I'm done. Have a great day.
Thanks, May.
You're welcome.